This is a case study on presumptive taxation, and the sections which are covered here are 44B plus section 172. These deal with shipping business of non-resident, and we will try to solve a problem where the distinction between these two are brought out. GGC and Company is a reputed firm of chartered accountants in Gurgaon dealing in audit, direct tax, GST, M&A, and cross-border taxation, etc. Following clients approach such firm for computation of their income tax liability and filing of their income tax return. So there's a CA firm, and they've got two clients here, one who's opted for 44B and the other one who's opted for 172. We are required to calculate their taxable income under these two sections and then basically compute their tax liability. Mr. A non-resident, approached such firm for calculation of his income tax and filing of his income tax return in India for the previous year 1920. He is a tax resident of France and is engaged in the business of operation of ships in international traffic. So the first condition relating to the fact that a non-resident should be engaged in operation of ships in international traffic is something which is satisfied. He provides the following data for filing his income tax return. On September 1, 2019, Mr. A collected rupees 30 lakh in California, so collected outside India, for shipping of goods from Chennai port. Where's Chennai? Chennai is in India, from India to California, to outside India. It includes demurrage charges of rupees 1 lakh and handling charges of rupees 2 lakh. When we calculate the gross receipts for the purpose of section 44B, let me clarify one thing up front. The demurrage charges and the handling charges form part of the receipt. So the fact that this has been indicated to you that it includes demurrage charges and handling charges would not make any difference. This is something which will be included. Therefore, these 30 lakh, they will be included in the gross receipt for purpose of 44B. Why? The reason is simple. Anything you receive outside India, but which is in respect of shipping for goods from India to outside India, is considered as income for the purpose of section 44B. Therefore, this 30 lakh is going to form part of the gross receipts. So as I move here, let me just write this, that the income includes 30 lakh. On October 1, 2019, Mr. A collected 40 lakhs in India. So the collection has been in India for shipping of goods from a port in New York. For the purpose of section 44B, I didn't tell you that this was towards the end of the question, but this is how you have to calculate. Amount received in India, even if it is respect of shipping of goods from outside India, is considered as taxable income. Therefore, along with 30, even 40 lakh will be added to the gross receipt. On October 31, 2019, Mr. A collected 50 lakh in New York, so receipt in New York, for shipping of goods from port in New York to California. Now, the money has been received outside India, the goods are shipped outside India, and the destination is also outside India. In such a case, this income is not included as a part of the receipts. He has incurred an expenditure of 5 lakh for the purpose of business in India, out of which 50,000 was paid in cash. Again, when you are computing income under section 44B, the expenditure incurred is not allowed as a deduction. Therefore, the amount of 5 lakh will not be allowed as a deduction. He has also brought forward business loss of 10,000 from trading business in India, which was discontinued last year. Now, so the total income is how much? 70 lakh. We will just see the calculation for this. The brought forward losses actually, unlike the case of expenditure, are allowed to be set off against the taxable receipts. Therefore, when we look at the calculation, these brought forward losses will actually be set off. So let me just show you the calculation for this now, and So when you have the receipt of 70 lakh, 7.5% of that is considered as taxable income, which is 5 lakh 25,000. Business expenditure, like I said, will not be allowed as a deduction. Since the business expense is not allowed as a deduction, therefore whatever has been paid in cash will also not be disallowed. There's no deduction, so there is no question of disallowance. Therefore this will be nil. The brought forward business losses will now be set off against this income which has been computed. The reason why I did not actually do the calculations in the previous one was I cannot set off this 10,000 from 70 lakh. I have to first calculate what is the taxable income, and from that I need to set off the brought forward losses. This gives me an income of 5,15,000, against which there is a tax of 15,500 and a cess of 620, which results in a total tax liability of 16,120. At the cost of repetition, if the goods are shipped from a port in India, it is taxable in India. If the amount is received in India, it is taxable in India. But if the goods are shipped outside, the amount is received outside, then basically it is something which is not liable to tax in India. No business expenditure is allowed as a deduction while computing the gross receipt, the net receipt for 44B purposes. Right? Since there is no deduction of expense, therefore there is no disallowance for cash payment of expense. But the brought forward business loss is allowed to be set off against the taxable income and not against the gross receipt. Then you can calculate the tax. Now let's go back to the second part of this question. Here you have a company A Inc. which is engaged in shipping business. In their case, you have to calculate the income, the tax liability, if the assessment were on an ad hoc basis under section 172, subsection 4 of the Income Tax Act. A Inc., a non-resident company engaged in operation of ships in international traffic which are chartered from another non-resident company, Beta Barbados. So there's this company which has chartered ship. For section 172, both owned and chartered ship are considered. Chartered means something which you have hired, taken on rent. As long as you are in the business of operating ships, it doesn't matter whether you own the ship or you chartered it. It collects the following freights from its client. On December 1, 2019, it collects rupees 20 lakh in India for shipment of goods from New Zealand port to Indian port. So here, the receipt is in India. The goods are shipped from a port outside India, but the destination is in India. Now, in case of section 44B, we had considered this as a gross receipt because the amount of money was received in India. Will the same provision apply for section 172(4)? I will answer that question in a minute. Let's first go through the entire question. On December 30, 2019, it collects rupees 50 lakh outside India for shipping of goods from a port in India to California. So this is a simple case. Goods are port from a port shipped in India and a destination is outside India. It doesn't matter where the money has been collected because the movement of goods is from India. Therefore, this will be considered for the purpose of taxation in India. However, what you have received for shipment of goods outside India is not liable to tax in India. It doesn't matter whether the amount was received in India or not. Therefore, the taxable income in this case will be 50 lakh. Again, there is an expenditure of 2 lakh for the purpose of business in India, and there is a brought forward loss from a trading business in India which is 2 lakh. You are required to calculate the tax liability of A Inc. on the basis of ad hoc assessment under section 172, subsection 4 of the Income Tax Act. Now, when you look at the calculations for this, like I told you, only 50 lakh will be considered as income. So 7.5% of that is 3,75,000. Just like in the case of 44B, the deduction of expenditure is not allowed here. Therefore, the net income is 3,75,000. Now here comes the difference. The company has a brought forward business loss of 2 lakh, but for the purpose of section 172, this is not allowed as a deduction, unlike section 44B, where this was allowed as a deduction. And therefore, the income after set off will be 3,75,000. Because it's a company, you just need to note this, that the tax rate will be 40%. The cess will be 4% on the tax, so 150 of tax, 6,000 cess, and total is 1,56,000. So what is the key difference? The only key difference in this was twofold. One, what you received in India in respect of goods shipped outside India is not considered for 172(4). The brought forward business losses are also not allowed for the purpose of section 172(4). I hope with these 2 points this question should be clear. Let's move on to the next case study.